How badly is the UK economy really doing? Is this all just news and headlines, or is the UK economy in real trouble? After a surprising contraction in January, and with the Bank of England having halved its growth forecast, and with the worst per-person productivity growth since 1850, and can anything be done to break the cycle? So growth is probably the most obvious place to start to give us a quick illustration of how bad things are or could be, but there is just so much more to it than that, which we're going to break down in the rest of the video. So official numbers show that the UK unexpectedly shrank in January, making it frankly the latest in a long line of bad economic news for the UK. Take a look here. This really just shows the kind of meagre growth that we've been experiencing for basically the last decade. But when you expand the time horizon, that's when the story starts to get even more bleak. The UK economy has just made so little progress since the financial crisis. And look at this from Reuters. Britain's economy will grow more slowly than previously expected in 2025 and 2026 as global growth is hit by uncertainty, the OECD said on Monday. The OECD lowered its forecast for British growth this year from 1.4% to its December forecast of 1.7%. Growth in 2026 was trimmed from 1.3% to 1.2%. And this has really been the same since the financial crisis. In fact, taking a longer term view, UK economic growth has been weaker since the financial crisis. According to ONS data, GDP growth slowed from an annual average of 3% between 1993 and 2007 to 1.5% between 2009 and 2023. Now, we should point out that the government was very quick to lay blame on the tariffs that Donald Trump has been flailing around with for the last few months. But we should also point out that this is a bit of a porky because the UK wasn't hit by tariffs in January. But it is fair to say that he has threatened them to the UK both on the campaign trail and since he was sworn in. And as you can see here, this has had an effect on business confidence here, and this has also trickled down to consumer confidence, which you can see just here with this slight drop-off. So we've discussed how the UK growth record over the last decade has been in real tatters, frankly. But the other concern we should all be worried about is the rising spectre of inflation. The combination of low or stagnating growth and the rising inflation is called stagflation. Yeah, I mean, I'll put my hands up and I say, based on that name just there, economists maybe aren't the most creative bunch, but anyway, I digress. Let's move on. So whilst we are moving away from a period of high inflation, historically high inflation, frankly, there was wide speculation towards the end of last year that inflation looked as though it was going to be falling to or even below the Bank of England's 2% target. But then the bank has increased its forecast for inflation as well. More good news. Look here. If you take a look here, you can see they're expecting inflation to stay above the 2% target, frankly, for the foreseeable future. This will likely dash any hopes of successive rate cuts throughout the rest of the year. And again, there have been plenty of forecasted rate cuts for the UK through to 2025, with some analysts expecting interest rates to be close to 3.5% by the end of the year. But given that the Bank of England has just voted to hold rates and we're already well into the year, it seems kind of unlikely at this stage. And some of those forecasts were made before Donald Trump started talking about tariffs, so expect that to potentially edge even higher. Now, whilst we aren't likely to see inflation rates hitting double digits again like we did in 2022, the fact is that inflation is staying above target and we have slow growth. I mean, yikes, it's bad news central right here. Now, the higher inflation environment that we just discussed is likely to feed through into higher interest rates, and this is likely to have a downward impact on investment. Basically, when it's cheaper to borrow money, both businesses and employees are more likely to go out and invest, because the return they can make on investing is better than the rate of return they get from just having cash in the bank. But we can split investment into two categories. One is public investment and one is private investment. If we're totally honest, it doesn't really matter which one you look at. The story for the UK is just about the same. Now, public sector investment accounts for about 15 to 20% of total investment in the UK. The rest comes from individuals, UK businesses and foreign direct investment. Now, if you take a look here, you can see the UK in red. The UK is at the bottom of the barrel once again. But I think that the importance of investment cannot really be overstated. In some ways, it's the genesis of growth. Pretty much everything that we've discussed so far in this video, and we will discuss in the rest of the video, could trace its roots all the way back to investment. And in the UK's case, it's complete lack of investment. And I think this is nicely summarised by this quote from the IFS. Indeed, many economists view low rates of public investment as a key contributing factor to the UK's lacklustre productivity performance. More on that a bit later. And we should point out that we see the same thing with private investment too, not just public investment. Take a look here. You can see the UK right at the bottom, once again, with this pink line, just well below the G7 average and falling even further. We'll point to this study here that just came out, which finds that, quote, every additional pound the government invests in the UK economy turns into £9.30 of additional output after 20 years, according to research from the University of Lisbon. This return, which averages 11.8% per year, makes the UK the most effective investor of public money. In comparison, UK private sector investment only returned a multiple of 1.89 over 20 years, the study found. This is all captured in this statement from one of the authors. The results of the study are clear. Public investment works are remarkably efficient at boosting long-term growth. And frankly, you will find few areas where a lack of investment has been more acute than in productivity. Now, this is really where we start to get into the nuts and bolts and the root of the UK's economic woes. It's fair to say that the UK's productivity growth has been absolutely anemic. Since 2007, output per hour worked has grown by just 0.5% a year. If it had grown in line with the pre-crisis trend, then income per capita would be about 25% higher today than it currently is. And the frustrating thing is that this gap between the two lines is only going to widen over time. Now, we'll come on to this in a little bit more detail later, but there are often these shrill screams from people about how the UK debt is very high, we can't afford to be spending money, but this is actually just not true. And in fact, the opposite is very much the case. Take a look at this here from the CBI. They did some analysis looking at UK productivity. The blue line shows 0.5% productivity growth per year. And as you can see, debt to GDP absolutely skyrockets. But the yellow line shows what happens if labour productivity increases by 2.5% per year and actually shows debt to GDP falling. So whilst it may sound counterintuitive, the government needs to invest more to make UK workers more productive in order to keep debt under control. And there was this analysis here that found the UK has really three key challenges when it comes to productivity. The first is chronic and broad-based underinvestment. And this is something that we've discussed earlier on in the video as well. Although underinvestment is chronic in the UK and has been ingrained in the UK's economic system for decades, there is evidence that the austerity measures in place from 2010 have particularly contributed to weakened public investment. And there's also this follow-up. Emerging evidence also indicates that Brexit has had a negative impact on private investment. More on that a bit later. The second thing they found is a lack of productivity enhancing practices. The UK is very active at the frontier of science and knowledge creation. It is regarded as one of the most innovative nations, ranking 4th in the 2023 edition of the Global Innovation Index. But what the research finds is that this just isn't filtering down into productivity for the average UK worker, and that really is another crux of the problem. And the third and final thing that the paper looks at is a lack of joined-up policies. So what does all this mean practically? This means that in the UK, it's difficult for any national government policy to be translated into an effective local policy. And at the same time, local governments are under-resourced and lack the authority to develop and implement proper solutions that suit that local authority. Next up, we have wages. Take a look at this here. The idea here is pretty simple. If a person can produce more in the same amount of time, then they should attract a higher wage, which their employer can afford to pay them because they are getting more from the same worker in the same period of time, which we can also see on this graph just here in the pink line and the blue line. And what you can see here is just the complete flatlining of wages. It's not that surprising given everything that we've talked about. And when you start to look at real wages, these measures vary, but they're usually after inflation or consider housing costs. If you look at real wages, the story gets even worse. And the truth is that there hasn't been much in the way of policy to try and improve the situation, but more should be done. Given the strength of the link between pay and productivity, it just seems like it's really important for public policy to attempt to make workers, particularly low-wage workers, more productive so they can attract a higher income. And take a look at this. While employment growth has been strong, average earnings growth has been dreadful, for which read almost non-existent. Gross domestic product per head today is nearly £11,000 lower than it would have been if the pre-crisis trend had continued. So, unfortunately, one of the features of flatlining wages is that it exacerbates inequality and poverty. People who derive their income from work rather than capital, like the ownership of assets, stocks, shares, property, that sort of thing, see that their living standards get worse and worse and worse. The numbers in the UK really bear that out, and these are some pretty shocking statistics, frankly. A third of kids in the UK grow up in poverty, 21% of working age adults experience poverty, absolute poverty in the UK has been the highest it has for 30 years, and 50 families in the UK have more wealth than the bottom half of all families. Now, if you put aside the morality of some of those statistics, and they are just absolutely horrifying, but this is also a fundamental economic issue. If you have people who are barely able to get enough money together each month to cover the bare essentials, then that's not exactly the basis for a strong economy. It gives you weak domestic demand. It means that there isn't a strong middle class to drive economic stability. and high poverty means that fewer people can participate really effectively in the economy. And this just ultimately leads to a plethora of bad economic outcomes and often will lead to vicious cycles. Low investment leads to low wages, low wage growth. This higher inflation means that the cost of living has absolutely skyrocketed at the same time as people's wages are flatlining. It's just madness everywhere. Now, all of these outcomes don't happen by chance. They're not all the subject of coincidence and the universe doing its thing. And whilst clearly the government will need to raise taxes in order to improve public services, ultimately their choice to increase employer national insurance contributions is undoubtedly going to lead to some combination of higher prices, freezing wages, or reduced hiring. Shepherd Neame, the UK's oldest brewer operating 290 pubs, announced plans to raise beer prices. The company anticipates an annual increase cost of £2.6 million due to the budget's tax measures. But taking away from a single anecdotal example, there was also this from Reuters. Britain's high streets will likely see an acceleration in closures this year as extra costs imposed on businesses by the government's first budget take their toll, according to a report from advisory firm PwC, saying, quote, "In the short term, higher costs following April's increases in the national living wage, employer national insurance contributions and business rates mean we're likely to see an acceleration in closures as marginal locations become unviable for retail and hospitality operators." And this is really the thing. Ultimately, increasing national insurance contributions for employers is a cost to a business, which they will pass on to their customers. And with the budget in mind, we move on to debt. So take a look at this graph. In 2020, the UK government spent about £25 billion that tax year on interest payments. But jump forward just a couple of years, and that number has gone stratospheric to over £110 billion per year. This has basically been driven by two things: the Bank of England increasing interest rates pretty aggressively in 2022 in order to combat inflation. And the second thing is the unprecedented intervention and spending that we saw during 2020 and gradually tapering off into 2021. Now, this is problematic for a few reasons. As interest rates have increased, therefore interest payments have gone up too. This means that more of the government purse has gone to servicing debt, which is less productive, rather than making investments into the economy that would improve the overall productive capacity. Now, whilst the UK isn't necessarily an outlier when it comes to debt to GDP, which you can see just here, somewhere between the US, Spain, France and Canada, so other comparable developed countries. And this is something that should really worry people in the UK. But we should also differentiate between accumulating national debt to pay for day-to-day spending compared to borrowing for capital expenditure. But that debate is for another time. We will cover that in another video. Now, I am very reluctant to revisit this, but it would be remiss of me not to. And the best analogy that I've seen is that Brexit is like a slow puncture on the economy, not like hitting a tree, but gradually letting the air out of an already flat economy. Am I kind of labouring this metaphor a bit too much? Okay, I'll stop. In any case, an independent report by Cambridge Econometrics, commissioned by City Hall, shows London has 290,000 fewer jobs than if Brexit had not taken place, with half the total 2 million job losses nationwide coming from the financial services and construction sector. Brexit has permanently diminished trade efficiency in the UK by introducing customs checks, rules of origin requirements and regulatory divergence from the EU. And it's these barriers really that will increase the cost both for exporters and importers, which overall on the global stage will weaken the UK's international competitiveness. But we should also know that this is a gap that is only going to get wider and wider over time. It wasn't a one-off event. It's going to be something that will consistently pull the economy down and drag it backwards. Now, I know we've talked about it already, but take a look at this graph. This is investment going up nicely, maybe not as fast as it had done before. And then we get to here, the referendum, where investment just completely flatlines. And this is bad news for the economy because it seems the prospect of improving the deal that we have with the EU seems kind of politically toxic, and that the other trade deals that was supposed to be queuing out the door and around the corner for so far haven't, and the ones we have signed certainly haven't materialised to the point where it would make up for the loss of trade with the EU. Now, I've kept this one till last, largely because it's an external factor and it's the looming and likely escalating trade war with the US. I think we should also acknowledge the role that Donald Trump is playing in the UK economy, because whilst the UK has, for the most part, been reasonably isolated, for the time being at least, it does at least raise a broader economic issue about how the UK will be affected. The escalating and intensifying trade war is likely to see more tariffs, greater barriers to entry, and all of this just means that consumers are going to pay higher prices at the shelves, at the pumps, wherever that is they're buying their goods. That's just the fact of the matter. So I suppose the answer to both the questions at the start of the video, how badly is the UK economy really doing? Well, basically about as badly as it has done for basically the last 15 years, which is not great. What pretty much every single economic indicator and variable tells us is that the UK has done pretty badly, and that is turning into a big problem. But then we get to the obvious follow-up question. Is the UK economy in serious trouble? Yes, frankly, it sort of is. There's no doubt that this slow puncture of an economy is going to turn into be a problem. Usually when you look at an economy, you can see spots of it doing well, others not so well. But in the UK, unfortunately, as we've talked about in other videos, is just a sea of bad news wherever you look. And really, that's the concerning part, is that there doesn't seem to be the will to enact the policies necessary to help stabilise the economy and move it out of this low growth, higher inflation environment to a more productive environment. If you like this video, we have 2 videos just here where we talk about the health of the UK economy and some policies that could help to improve it. And we go into much more detail. I really recommend you watch both of them because in this one, we've talked about the problems, but here we can talk about some of the solutions. Thanks very much for watching Modern Money Talk.